Good morning, and thank you for joining us at the SMSF Trustee Empowerment Day virtual day today. My name is Lauren Ryan, and I'm from Think Tank Property Finance. Today, I'm going to be talking to you about how you can generate returns through different debt instruments, and we're going to take a look at a few different structures and having a look at the pros and cons of some of those structures. And to finish off, we'll take a look at how Think Tank generates the return that we do through the debt capital markets. And before we start, just a quick disclaimer on the screen that everything that's discussed today is general information, not personal information. I don't know you, I don't know your personal circumstance, so everything discussed today will be general information only. Some of you may be familiar with Think Tank. We are a non-bank property lender. We started in 2006. Our primary focus is lending to SMEs or self-managed super funds or companies or trusts who are looking to purchase commercial or residential property, small ticket commercial or residential property. So our primary borrower is business owners or people who derive their income from their business or who are looking to purchase through an entity. In 2017, we opened up the Income Trust and High Yield Trust. These are pooled mortgage funds available for investments from high net wealth, sophisticated or wholesale investors. And we operate quite heavily in the debt capital markets. So we issue RMBS, residential mortgage-backed securitizations, and commercial mortgage-backed securitization transactions a couple of times a year. In 2018, AFG, Australian Financial Group, bought 30% of the business. Other than that, we are privately owned, and many of our key founding staff remain with the business today. So in today's presentation, we will have a look at how debt instruments generate returns. We will compare the pros and cons of a few different types of structures. Now, much of what I will discuss is open for interpretation, and other people may have differing views to that. And finally, we will finish off with how Think Tanks generates income returns through the debt warehouses and the debt capital market structure. The reason why I included this piece of the presentation, I often get asked, how does Think Tank generate a return over and above what the average borrower is paying? And hopefully in these last few slides at the end of the presentation, I will explain to you how that works. When it comes to investing in debt, there's an income component and a capital component. So addressing the income component first, investors provide funding to a lender, an originator, a fund manager. They then issue a loan or a mortgage or to a borrower. Those borrowers will use those funds to purchase an asset. In this case, we're looking at property. When the borrower makes those monthly repayments, the originator will take a small fee for managing the agreement, and then investors will receive monthly income returns. There is a capital component to investing with debt because you have been committed to, your capital has been committed for a period of time, generally 6 to 12 months and above, and your capital is illiquid. You aren't able to access that capital. Because of that, you get what's called a liquidity premium as part of your return. If the borrower is unable to repay their mortgage, the originator, the fund manager, will take possession of the property, try and work with the borrower, and if that's unsuccessful, take possession of the property, sell the property, and have the funds returned back to the investors. In a situation where the money that has been obtained at the sale of the asset is less than what the investors are owed, then investors may be exposed to capital losses. So the first structure that we will look at is the direct pooled mortgage fund. This is the structure that Think Tank offers to private investors. And a pooled mortgage fund is where all investors are exposed to the same pool of assets. Those pools are dynamic, meaning new loans get originated and discharged every day. Investors don't have any control over the assets in these funds. They are predefined before you invest in this style of structure, and you should be receiving frequent reporting to ensure that the loans within the fund and the assets are as prescribed when you joined. So we'll take a quick look at some of the pros and some of the cons of a direct pooled mortgage fund. The first one is a pro is a high level of diversification that can be quite challenging for investors to obtain themselves unless you have a very large pool of funds to start with. You will generally receive frequent income distributions. Now, this also should be predefined before you invest in the fund. Some offer monthly, some offer quarterly, biannually, and annually, but that circumstance is relatively rare. Monthly is I would suggest is the most common. There's also a loss provision in pooled mortgage funds. That's also a predefined percentage of the overall funds under management that is left in cash, and that is there to absorb any losses first. If that loss provision gets absorbed, then investors may be exposed to capital losses. Generally, these operate on a pro rata basis, so you would be exposed to a percentage of that loss equivalent to the percentage of the fund that you own. So if you were investing $1 million in a $100 million fund and a loss came through, you might be exposed to 1% of that. In this style of investment structure, the returns are often variable or often linked to some form of benchmark rate that has got a relationship with the RBA cash rate. In Thinktank's example, we use the bank bill swap rate 30 days, and that generally is linked very closely to the RBA cash rate. There probably are funds out there that offer fixed terms in these pooled structures, but I would argue that the majority of them have a floating rate capacity. Another pro is that you're exposed to direct loans from the originator, and there's accountability from that originator because you're the one investing with them, and then they're the one lending those loans. So you've got access to that originator if you have any questions about the loans being originated or if something starts to go a little bit wrong. Many of these funds are open-ended, which means that there's new money coming into the fund and being withdrawn at the same time. You are often asked to commit capital for a predefined period of time, but there's money going in and money coming out, as opposed to a closed-ended fund where funds are raised for a set period of time and there's no entry or exit during that period. Some of the cons on this style of structure is that liquidity is limited. In all of the structures we are going to look at today, this is a factor. Liquidity is challenging in this unlisted space. Another con is investors don't have any control over the asset selection. You are relying on the originator to manage the credit underwriting and taking the appropriate security for the loans that they're writing, and the investor doesn't have any control over the assets within the fund. There's limited transparency on the underlying borrowers. Again, you are relying on the manager to do all of that due diligence and to make sure that the borrower is able to service the debt, that the asset is quality, and that the loan-to-value ratio is appropriate for the risk that's being taken. And the last one, during challenging economic times, pooled mortgage funds can freeze redemptions. This is done to try and make it fair and equitable for everybody looking to redeem. These situations generally do only occur during quite severe economic contractions, and the last one we saw was really 2008 in the GFC. The next structure we'll take a look at are third-party credit funds or actively managed credit funds. These are not too dissimilar to actively managed equities funds. Thinktank works with a lot of these third-party credit funds in our institutional facilities as well as in the debt capital markets. One of the pros is in the debt markets, it has been quite difficult and expensive to offer these kind of debt products directly to investors. So many originators, many issuers stick with the institutional investor path and only offer these products to third-party funds. Those funds then they go and raise money from private investors such as yourselves so that they can invest a large sum in one single transaction to the issuer rather than the issuer trying to raise that sum of money from lots and lots and lots of investors. Another pro is that investors in these funds obtain originator diversification, which you don't have with a direct pooled fund, or you need to try and source that yourself by investing in multiple direct pooled mortgage funds to obtain originator diversification. Generally, through a third-party credit fund, you will have some exposure to multiple originators through that one investment channel. Investors are leveraging the fund manager's industry relationships and expertise when investing in these third-party credit funds. Again, not too dissimilar to actively managed funds, where the actively managed equities funds, where the fund manager will have the relationship with the issuer and will operate on your behalf, whereas you, as the private client, private investor, might not have that relationship directly with the issuer. Third-party credit funds also have the access to a variety of investment classes across the debt capital stack. So you're not only exposed to one risk return profile, you might have multiple different risk and return profiles available to you through this one investment channel. Some of the cons, it's not too dissimilar to an actively managed equities fund. An actively managed debt fund generally has slightly higher fees because you are paying for the expertise of that fund manager, going and forming those relationships with the issuer and accessing those harder to source investments. The issuer or the fund isn't the originator, so if something goes wrong and you want to speak directly with the fund that's responsible for investing your money, you might have a challenging time of doing that. Most third-party credit funds have the expertise and will be able to answer your questions, but there might be some people out there who would prefer to be able to speak directly with the product that they're investing in. Many of these funds have a slightly higher minimum investment than you might find with a direct fund. Again, you have minimal direct contact with the issuer. Most of all of the communication would be going through the third-party fund there. And the third party has no direct control over collections and arrears management. That is at the responsibility of the originator and of the lender. So in a worst case scenario, you might find that the fund manager that you've invested in is unable to influence the originator and the lender when it comes to arrears and collections management. The last one we'll take a look at is investing in single projects or single loans. Many of you might have had experience with this style of investing in the past, and many of you might use these kinds of products at present. Unlike the other two structures, investing in a single project offers investors control over the projects that you invest in. Generally, these projects have a predefined term, a predefined return, and a predefined LVR and loan amount. So you have a lot of the information upfront before you are investing in this style of debt instrument. In some cases, there might also be capital upside available. The other two products are probably more geared towards purely income, whereas through single loans, single projects, or syndications, as they might be, you might be familiar with, there can be capital upside as well as income. And in some contributory single project, the originator will take a first loss piece. It's really important for investors to know where they sit in the priority, who gets paid first, who gets paid last, and whose capital is at risk first. Because if the market turns or if the borrower is unable to repay, it's important to know when you get paid and whether the originator that you've trusted with your money has any equity or skin in the game. On the con side of things, achieving diversification can be quite challenging through these style. They generally have a slightly larger minimum investment, so you might find that a larger portion of your portfolio is allocated to less assets, and that might not quite meet the optimal asset allocation that you're trying to seek. Many of these style of projects came about after the GFC, when the banks stepped down from these style of loans or these style of projects that often get funded through this structure. The banks stick to prime lending, prime residential lending, I should say. And at that time, it left the door open for the non-banks and alternative lenders to take up the market that was available to them. Many of these project style of in single project investing have some construction or development risk, and the liquidity during those projects is quite low. And because of the style of asset that is being funded, they can be quite challenging to sell. Generally, it's a much larger asset value, and during times of stress, those can be harder to sell if the originator needs to liquidate. And again, investors have limited control over collections in these style of funds. Now we're going to take a quick look at investing through the debt markets. I will be using Thinktank's debt warehouse as an example here. I work for Thinktank. I have a relatively intimate knowledge of how their structures work. Many other non-banks will operate in a similar way, but as I don't work for them, I can't share how their structures work. This is more for informative and educational purposes as well. So going back to the first question that started this presentation, how does Thinktank generate returns over and above what the average weighted borrower rate is? And the reason we're able to do that, through the debt warehouse, we obtain the majority of our funding needs from a couple of major banks in Australia, depicted in the A note in this slide. We're able to obtain that funding at quite a tight price because of subordination. And subordination means that the note below agrees not to get paid income until the note above it has been fully compensated. So being the A note at the top of the debt capital stack, the bank gets paid first, followed by the B note, followed by the C note, D, E, and F. You can see in this diagram the B, C, and D notes are generally funded by a mezzanine style funder or a private credit fund. As I mentioned earlier, Thinktank engages quite a few private funds to invest in these notes, and they're still institutional investors. Other investors might be the likes of an annuities company, insurance companies, superannuation companies, any kind of company that is looking to receive monthly income payments without taking on equity risk, which is at the bottom of the debt capital stack. Underneath the mezzanine funder is the equity tranche. Now, I'd like to say that this depiction here is all a first mortgage structure. So the borrower's equity sits underneath. In the equity tranche, you have Thinktank, who takes the junior equity piece, which means Thinktank's income is at risk first and our capital is at risk first, because Thinktank doesn't get paid any income until everybody else gets paid. And if there is a capital loss, it gets absorbed from the bottom up. Above Thinktank sits the income trust and the high yield trust investors. The income trust and high yield trust have exposure to notes in the debt warehouse, which is depicted in this diagram here. They also have direct loan exposure. The income trust has direct loan exposure to first mortgages, and the high yield trust has a small direct exposure to second mortgages, where Thinktank owns the first mortgage. Now, going back to what I said at the start, Thinktank is able to obtain the majority of the funding needs in this debt warehouse from the bank at quite a tight price. In reward for the mezzanine funders and for Thinktank taking the equity piece, taking the higher risk, we are able to offer a higher return. Now, the percentage of the overall funding facility that we require in the equity tranche is quite small. So whilst we are paying quite a high rate of return for that investment, it's a very small percentage of the overall funding needs. And that's important. I'll show you in the next slide when we're looking at the weighted average borrower rate versus the cost of funds. So we're looking at some metrics from the 31st of August. As we're still finalising our August numbers, I don't quite have the weighted average cost of funds for August, so these figures are as at July. Due to the RBA not raising rates yesterday, on Tuesday, the 5th, I suspect that that these costs of funds will remain relatively relevant. So weighted average borrower yield, which is the average rate the borrower pays, sits at about just over 8%. And the weighted average cost of funds, which is what Thinktank pays back to investors as a blended rate, the weighted average, is 6.29% as at the 31st of July. The difference between the borrower rate, what Thinktank receives from the borrower, and what we pay to investors is called the net interest margin, which is a phrase that many of you might be familiar with if you've worked in banking or have been around banking for some time. That net interest margin is up to Thinktank to manage. And we manage that by being able to obtain the funds from the bank that sits in the A note in this example at quite a tight price. So this weighted average cost of funds includes the returns that we pay to our income trust and high yield trust investors. And even though we're able to pay investors right now 7.65% in the income trust and 10.55% in the high yield trust, the percentage of the overall funding facility is quite small compared to what we are able to obtain from the bank at quite a tight price. That the overall cost of funds, when you look at all of the percentages that we're paying out to our investors, is sitting at around 6.29%. From that net interest margin, Thinktank then uses that cash to pay business expenses, staff costs, and we also reinvest a lot of that money back into the business by purchasing the equity notes in our transactions. A few years ago, we opened up a residential mortgage-backed securitization program. We hadn't issued an RMBS in the market before. And even though we've had a lot of success in the CMBS, the commercial mortgage-backed securitization space, we hadn't had any runs on the board in the residential mortgage-backed securitization space. So the market required us to invest a higher percentage of equity in that transaction. And the residual cash, the net interest margin, the cash that's left over once we've paid all of our investors, that is the capital that is used to invest in that equity tranche. Once we got a few runs on the board and we were able to prove continued performance, the amount of the percentage of equity that was required was able to decrease. And the reason being, we had a lot more interest from other credit funds and other institutional investors in the B, C, and D notes who wanted to purchase those notes when we issued those transactions. And over the last few transactions that we've issued, we've had more bids than we've had capacity. So as at the 31st of August, our loan balance, portfolio balance, sitting about 5.3 billion. Average loan size is 600,000. So as I said earlier at the start, we are a small ticket lender, which means we write lots of small loans all across the country. As you can see, almost 9,000 borrowers, 9,000 loans all across the country, and the weighted current LVR being 66%. So there's about 34% worth of borrower's equity sitting in the portfolio there. And as at the 31st of August, we have 2% of our loans in arrears. That's across the entire portfolio. So that brings me to the end of the presentation. I hope that helped explain some of the different characteristics of a few different structures, perhaps giving you something else to think about when you're looking at your own portfolio and which structure suits you. Every investor has a different view on how much liquidity versus the return versus the control over assets that suits them. And thankfully, there's lots of different options available to you. And hopefully this presentation has also helped explain and answer the question, how can Thinktank pay 7.65 on the income trust and 10.55 on the high yield trust when our weighted average borrower rate is about 8.09%. I will be available on the virtual booth all day today. And if you've got any questions, please don't hesitate to contact me. And thank you so much for attending today and have a wonderful day.
Today's SME and SMSF market relies on fit-for-purpose finance and investment solutions that genuinely meet the needs of both borrowers and investors. Thinktank Property Finance is a knowledgeable and established lender larger than most Australian credit unions and building societies. We offer financial solutions for borrowers and high net worth, wholesale and sophisticated investors. We provide conservative mortgage finance to credit-worthy borrowers, secured by mortgages over everyday Australian residential and commercial properties. Thinktank's investment products pay interest monthly, so investors receive a reliable, no-fuss income stream derived from a diversified pool of mortgages. Thinktank offers investors a range of investment options to cater for a variety of risk, return, and capital protection preferences. Thinktank has been a trusted brand in Australian financial services since 2006. We have a proven track record of performance in investment and lending in the way we've supported our borrowers and prioritised the interests of our investors through both the good times and the challenging times. We are highly committed to delivering for our investors and maintaining the strong institutional relationships we've built over many years. If you have an interest in regular income investment alternatives, we may have a solution that works for you. Please come and talk to us. We look forward to discussing your needs.